This presentation is for Chapter 8, Flexible Budgets and Standard Cost Systems. In Learning Objective 2, we will identify the benefits of a standard cost system and understand how standards are set. Most companies use standards to develop budgets. A standard is the price, cost, or quantity that is expected under normal conditions. For example, Cheerful Colors expects the direct materials to cost $1.75 per batch of 100 crayons. Therefore, the standard cost for direct materials is $1.75, and that was the amount used to develop both the static and flexible budgets. The terms standard and budget are sometimes used interchangeably. However, a budgeted amount generally indicates a total amount, whereas a standard amount is a per unit amount. In the case of direct materials, the standard is $1.75 per batch, and the budgeted amount for 52,000 batches is $91,000, or $1.75 per batch times 52,000 batches. Cheerful Colors uses a standard cost system, which is an accounting system that uses standards for product costs, direct materials, direct labor, and manufacturing overhead. Each input has both a cost standard and an efficiency standard. For example, Cheerful Colors has a standard for the cost it pays per pound of paraffin wax. This determines the cost standard. The company also has a standard for the amount of wax it uses for making the crayons. This determines the efficiency standard. This slide summarizes the setting of standard cost. Setting standards can be the most difficult part of using a standard cost system. Setting standards requires coordination and communication among different divisions and functions. For example, the cost standard for direct materials starts with the base purchase cost of each unit of raw materials inventory. Accountants help managers set a cost standard for materials after considering purchase discounts, freight in, and receiving costs. Companies can work with reliable vendors to build relationships that ensure quality and on-time delivery of materials at an affordable cost. For direct labor, accountants work with human resources managers to determine the cost standard for direct labor. They must consider basic pay rates, payroll taxes, and fringe benefits. Job descriptions will tell the level of experience needed for each task. A big part of this process is ensuring that employees receive training and are paid fairly for the job. Accountants work with production managers to estimate manufacturing overhead costs. Production managers will identify an appropriate allocation base, such as direct labor hours or direct labor costs, or they allocate overhead using activity-based costing. Accountants then compute the standard overhead allocation rates. This slide shows the computation of Cheerful Colors cost standards for direct material, direct labor, and manufacturing overhead based on the static budget of 50,000 batches of crayons. The manager in charge of purchasing for Cheerful Colors indicates that the purchase price, net of discounts, is 31 cents per pound of paraffin. Delivery, receiving, and inspection add an average of 4 cents per pound, for a total of 35 cents per pound. Cheerful Colors' hourly wage for workers is $10, and payroll taxes and fringe benefits total $2 per direct labor hour, for a total of $12 per direct labor hour. Variable manufacturing overhead will total $37,500 based on 50,000 batches of crayons, which is the static budget. Fixed manufacturing overhead is $25,000, and overhead is allocated based on 12,500 estimated direct labor hours. Cheerful Colors has analyzed the manufacturing process and has set efficiency standards. Production managers and engineers set direct materials and direct labor efficiency standards. Efficiency standards are also called quantity standards or usage standards because they are a measure of how much input should be put into the manufacturing process. In other words, if employees are working efficiently without spilling or otherwise wasting materials, how much paraffin should Cheerful Colors put into each batch of crayons, the output? That amount is the direct materials efficiency standard. To set labor standards, companies can analyze every moment in the production process and then take steps to eliminate inefficiencies. For example, to eliminate unnecessary work, machines can be rearranged for better workflow and less materials handling. Companies can also conduct time and motion studies to streamline various tasks. For example, a plant can install a conveyor at waist height to minimize bending and lifting. Companies often develop efficiency standards based on best practices that is called benchmarking. The best practice may be an internal benchmark from other plants or divisions within the company, or it may be an external benchmark from other companies. Internal benchmarks are usually easy to obtain, but managers can also purchase external benchmark data. Manufacturing overhead is allocated based on direct labor hours, and the efficiency standards for expected direct labor hours have already been established, so no additional efficiency standards are required for manufacturing overhead. Surveys show that the use of standard cost systems is widespread in manufacturing companies in the United States and around the world. Standard costing helps managers prepare the master budget, set target levels of performance for flexible budgets, identify the performance standards, set sales prices of products and services, and decrease accounting costs. Standard cost systems might appear to be expensive. Indeed, the company must invest up front to develop the standards, and they must update them on a regular basis at least once a year. But standards can save accounting costs. When they're integrated with the company's enterprise resource planning system, businesses can easily track inventory costs, determine cost and efficiency variances, and make real-time decisions. Once standards are established, managers can use the standards to assign costs to production. At least once per year, managers compare the actual production cost to the standard cost to locate variances. And this exhibit on the slide shows the formulas for computing the cost and efficiency standards. A cost variance measures how well the business keeps unit cost of material and labor inputs within standards. As the name suggests, the cost variance is the difference in cost or actual cost per unit less the standard cost per unit of an input multiplied by the actual quantity used of the input. For example, if the actual costs are higher than the standard, the variance is unfavorable. An efficiency variance measures how well the company uses its materials or human resources. The efficiency variance measures the difference in quantities or actual quantity of input used less the standard quantity of input allowed for the actual number of units produced, multiplied by the standard cost per unit of the input. For example, if the actual quantity exceeds the standard quantity, the variance is unfavorable. This exhibit shows the relationships among variances and how to separate total flexible budget variances for materials and labor into cost and efficiency variances. So there is first the cost and efficiency variances will add up to the total flexible budget variance. Second, static budgets play no role in the cost and efficiency variances. The static budget is used only to compute the sales volume variance, or the variance caused because the company sold a different quantity than it thought it would sell when it created the budget. It is never used to compute the flexible budget variance or the cost and efficiency variances for materials and labor. And that is the conclusion of the presentation for Learning Objective 2.